Welcome to Module 7, where we'll be diving into single-family housing investment fundamentals. In this module, we'll explore how single-family homes generate value through three key areas: pricing drivers, investment returns, and tax strategies. We'll break down each of these components, starting with how pricing is determined in the market. Then, we'll look at the investment side, understanding the potential returns and risks involved. Lastly, we'll cover important tax considerations that can impact overall profitability. By the end of this module, you'll have a clear understanding of how these elements work together to create value in single-family housing investments. On this slide, we'll focus on the key objectives of the module, which center around understanding the factors that influence housing prices, especially in single-family homes. First, we'll analyze how location, demand, property condition, and broader economic trends come together to shape housing prices. These factors are crucial because they determine not only the current market value, but also potential future changes in price. Next, we'll evaluate an investment's potential by looking at cash flow, appreciation, financing options, and the overall return on investment, or ROI. This helps us understand the financial viability of investing in single-family housing, balancing income generation with growth prospects. Finally, we'll explain how different financial components like interest rates, property taxes, and depreciation impact the profitability of real estate investments. Grasping these tax considerations is essential for making well-informed decisions that maximize returns while minimizing costs. Together, these objectives will give us a comprehensive view of pricing, investment, and tax implications in single-family housing. When we talk about the housing market, especially single-family homes, it's important to understand that prices aren't random. They're shaped by four main forces that work together and influence each other continuously. First, location plays a crucial role. Factors like the quality of local schools, neighborhood safety and appeal, access to transportation, and nearby amenities all set the foundation for a home's baseline value. Next is demand, which can be very dynamic. The number of buyers competing for homes, how much inventory is available, and any supply constraints can cause prices to rise or fall quickly. Then, there's the condition of the home itself. Things like the age of property, any upgrades or renovations, ongoing maintenance, and even curb appeal impact how much buyers are willing to pay. Lastly, economic trends are a big driver. Interest rates, inflation, employment levels, and income growth all influence overall housing affordability, which in turn affects home prices. Each of these drivers doesn't operate in isolation. They interrelate and together create the complex environment that determines single-family home prices. Understanding this framework is essential for analyzing pricing, making investment decisions, and considering tax implications in the housing market. When we talk about location in real estate, it's really the foundation of value. The same house can vary greatly in price depending on where it's located. Several factors shape buyer demand quickly, starting with neighborhood quality. Things like good school districts, safety, local amenities, and curb appeal make a big difference in how desirable location is. Accessibility is another crucial aspect. Shorter commute times, easy access to public transit, and proximity to employment hubs all add convenience, which in turn boosts pricing power. Then we have growth potential. Areas seeing new employers moving in, improvements in infrastructure, or new retail developments often experience stronger property appreciation over time. We also need to consider local comparables. Recent sales nearby serve as benchmarks for pricing and help buyers understand what they're expected to pay, especially in single-family housing. Location often sets the upper limit on value even before any upgrades or improvements are factored in. So, understanding these location-based elements is key when looking at pricing, investment, and tax considerations for single-family homes. Let's talk about the factors driving demand in the housing market. When we see more buyers enter the market, it naturally pushes prices up due to increased competition. This can be fueled by population growth and more households looking for homes, which intensifies the competition for the limited available properties. Strong jobs and income growth also play a crucial role. When employment is solid and wages are rising, people have greater purchasing power, which supports higher home values. Additionally, the appeal of a neighborhood, things like good schools, safety, and local amenities, can make buyers more interested and increase their urgency to purchase. On the supply side, limited inventory tightens the market. When there are fewer homes for sale, sellers gain leverage, and buyers lose some negotiating power. Slow new construction further constrains supply, helping keep prices elevated over time. Another interesting factor is the rate lock effect, where owners who have low mortgage rates may delay selling, which shrinks the number of active listings on the market. When buyer demand meets limited supply, pricing tends to move upward. So, understanding both demand and supply dynamics is key to grasping housing market trends. When we talk about property condition, it has a significant impact on the price a home can command. A move-in ready home, one that's well maintained with updated finishes, tends to support higher list prices. These homes often sell faster, and buyers are less likely to ask for concessions because they see fewer risks. On the other hand, homes with deferred maintenance, those that have needed repairs, cosmetic issues, or general uncertainty about their condition, usually attract lower offers. Buyers factor in the cost and hassle of renovations, which drives the price down. Understanding this relationship is crucial, especially when considering single-family housing, where pricing, investment potential, and tax implications can all be influenced by the property's condition. Keeping a home in good shape not only preserves value, but can also make a big difference in its marketability and financial returns. Let's take a closer look at how economic trends influence housing prices. The core idea here is that macroeconomic conditions, things like interest rates, inflation, and employment, affect buyer affordability, confidence, and ultimately home values all at once. Starting with interest rates, when they rise, mortgage payments increase, causing purchasing power to fall rather quickly. This usually reduces affordability and slows down price growth in the housing market. Next, inflation plays a significant role by pushing up the cost of land, labor, and materials. These increased costs apply upward pressure on home prices because builders and sellers need to cover their own higher expenses. Employment is another critical factor. Stable job growth bolsters household formation and encourages stronger housing demand. When people feel secure in their employment, they're more confident about making significant investments, such as buying a home. Over time, these factors work together to create varying levels of price pressure. For example, rising rates typically cool the market, while inflation can drive prices up by increasing replacement costs and rents. Meanwhile, employment trends directly influence demand and activity in purchasing homes. Understanding these dynamics helps us grasp the complexities behind housing price movements and guides better investment and policy decisions. When evaluating a strong housing investment, it's important to consider three key pillars that work together. First is cash flow, which measures the monthly income remaining after you cover mortgage payments, taxes, insurance, and operating costs. Positive cash flow is crucial because it enhances your financial stability and resilience. Next, we have appreciation, which refers to the long-term increase in property value. This growth is influenced by market conditions, the strength of the neighborhood, and any improvements made to property over time. Appreciation represents the wealth you build for the future. Finally, financing shapes your returns and risk through factors like interest rates, loan terms, down payment, and leverage. The right financing structure can improve your overall return on investment while managing risk effectively. These three pillars, cash flow, appreciation, and financing, carry equal importance. A successful investment happens when income, growth, and debt structure all support each other. In other words, you need to look at the big picture and balance these elements to make the best investment decision. Here we focus on cash flow, which is essentially the monthly return you get from a rental property. Positive cash flow means that after covering all your operating and financing costs, the property still pays you. It's the difference between the income you receive and the costs you incur. For example, rent is your gross monthly income. Say you collect $2,400 in rent. From that, you subtract your monthly expenses, mortgage payments, taxes, maintenance, and insurance. In this case, these costs add up to $1,845. After subtracting these expenses from your rental income, you're left with a net monthly return of $555. Investors pay close attention to this figure because if your cash flow stays positive, it means your investment property generates a consistent monthly spendable return. This cash flow calculation is a fundamental way to assess the profitability of a rental property. As we look at the growth of value over time, it's important to understand how steady appreciation can significantly build equity. Historically, we've seen that property values tend to increase over longer periods. For example, over 5 years, appreciation might be around 8%, stretched out to 10 years, and it could be closer to 18%. Over 15 years, values might increase by 27%, and when you look at 20 or even 25 years, the growth can reach 39% or even 56%. This long-term appreciation is a key factor in building wealth through real estate. Even if your monthly cash flow remains modest, rising home values help build substantial equity over time. The quality of the location and the demand within the neighborhood are major drivers of these appreciation trends. Another critical point is that your holding period matters a lot. Even small annual increases compound year after year, turning into meaningful wealth. Additionally, forced appreciation, improving your property through renovations, enhancing curb appeal, or maintaining better condition, can accelerate this growth. So, when investing in single-family homes, it's essential to consider how pricing, location, investment strategies, and tax considerations all play roles in maximizing long-term returns. Here we have an overview of 3 common financing options and how they impact your investment. First, conventional loans typically require a down payment between 5 and 20%. They usually offer lower interest rates and come with terms of 15 or 30 years. Conventional loans are best suited for borrowers with strong credit and offer the advantage of lower long-term costs. However, they often require more cash up front and have stricter underwriting standards. Next, FHA loans offer a more accessible option with down payments as low as 3.5%. They feature competitive rates and similar term lengths of 15 or 30 years. FHA loans are ideal for those with limited cash reserves because they provide easier entry into homeownership. The trade-off is mortgage insurance, which can increase monthly payments and affect your cash flow. Finally, alternative loans often require a down payment of 20% or more and have higher interest rates. These loans tend to be more flexible or shorter in term length and are best for those looking for speed or unique financing solutions. Alternative loans can unlock opportunities not typically available through conventional lenders. The key takeaway is that the best financing option isn't always the one with the cheapest rate. Instead, it's the loan structure that aligns best with your financial goals and return strategy. Remember, loan structure influences your upfront cash needs, ongoing borrowing costs, and overall investment flexibility. Here, we're focusing on how to calculate the annual return on investment, or ROI, for a real estate property. The formula combines 3 key components: cash flow, appreciation, and tax savings, all divided by the initial cash invested. Let's break that down. Cash flow is the rental income you receive minus expenses, which in this example is $350 per month, adding up to $4,200 annually. Appreciation refers to the increase in property value, which is calculated at 2.5% of the $300,000 property price, giving us $7,500. Tax benefits include savings from interest, property taxes, and depreciation, totaling $3,300. Adding these together, we get a total return of $15,000. When you divide that by the initial investment of $90,000, which covers the $60,000 down payment plus closing costs, you end up with an annual ROI of 16.7%. This figure is important because it measures your total return on investment, not just the rent income alone. Now, let's take a closer look at some of the key tax benefits associated with investing in single-family housing. First, mortgage interest is a significant advantage. The interest you pay on your mortgage can actually reduce your taxable income, which in turn improves your after-tax cash flow. This means you keep more of your earnings while still managing your loan. Next, property taxes are another important consideration. These ongoing local taxes are generally deductible as operating expenses, helping to lower your overall tax burden as an investor. Depreciation is a powerful tool, too. Even though it's a non-cash deduction, it allows you to recover the cost of the building over time for tax purposes. This can create substantial tax savings by reducing your reported income. Finally, the capital gains exclusion offers potential tax relief when you sell the property. If certain conditions are met, you may be able to exclude some of the profit from your taxable income or be taxed at a more favorable rate, making the investment even more rewarding. Understanding these tax benefits is crucial in maximizing your investment's financial performance and ensuring smarter financial planning. Let's talk about the mortgage interest deduction as it applies to investment properties. When you pay interest on a loan for an income-producing property, such as a rental home, that interest can reduce your taxable income. This effectively lowers the after-tax cost of borrowing. For example, if you paid $12,000 in interest and your tax rate is 24%, you could save about $2,880 in taxes. But it's important to note when this deduction generally applies. The loan must be a real mortgage or another form of qualified financing, and the property should be used for investment purposes, not personal use. Keeping proper records is crucial. Track your lender statements carefully, document the purpose of the loan, and maintain accurate annual tax reports to support your deductions. This way, you ensure compliance and maximize your tax benefits while managing your investment property wisely. When it comes to property tax deductions, the key factor is how the property is used, as this impacts the tax benefits you can claim. For investment properties, property taxes are generally deductible as an operating expense against your rental income. This can significantly reduce your taxable income from those properties. However, for personal use homes, the state and local tax deductions are limited by the SALT caps, which means you might not be able to deduct a full amount of your property taxes. Importantly, rental property taxes are typically treated separately and classified as a business expense, so they don't fall under these caps. To maximize the benefit of these deductions, it's crucial to keep detailed and accurate records. If you have a property that's used for both personal and rental purposes, make sure you allocate expenses correctly between these uses. Also, coordinate these deductions with other factors like depreciation, mortgage interest, and your entity structure to optimize your tax position. Remember, proper documentation not only ensures you get the full deduction you're entitled to, it also protects you in case of an audit. Overall, understanding the usage-driven tax treatment of property taxes can directly improve your after-tax cash flow. When calculating depreciation, the first important step is to separate the value of the land from the building. Only the building portion is depreciable because land itself maintains its value and does not generate any depreciation deduction. For residential rental properties, we typically use the straight-line depreciation method over a recovery period of 27.5 years. This means the building's value is divided evenly across those years, providing a consistent annual deduction. By claiming this annual depreciation deduction, which is a non-cash expense, you can reduce your taxable rental income. This lowers your tax liability and ultimately improves your after-tax return on investment. To give you a clearer picture, let's look at an example. Imagine you purchase a property for $350,000. If the land is valued at $70,000, that leaves us with a depreciable building basis of $280,000. Applying the 27.5-year straight-line method, we divide the building basis by 27.5, resulting in an annual depreciation deduction of about $10,182. This is roughly what you could deduct each full year before considering any mid-month timing adjustments. When we talk about tax loss harvesting in real estate, the main idea is that early paper losses can actually reduce your taxable income, even if the property is bringing in positive cash flow. One key factor here is depreciation, which often creates a tax loss before the property starts showing a significant accounting profit. The core concept is that while losses are generally considered passive, there are exceptions. For example, if you actively participate in managing the property, you might be able to use up to $25,000 of those losses against ordinary income, although this depends on your income level. If you can't use all your passive losses in one year, they don't disappear. They carry forward to offset future passive income or gains when you eventually sell the property. Let's put that into perspective with an example from year one. Say you have $36,000 in rental income. Your cash expenses and interest payments total $24,000, and depreciation adds another $11,000 in deductions. Doing the math, your taxable result is a $1,000 loss, despite having $12,000 in positive cash flow before depreciation. This is an important strategy in single-family housing investment because it shows how tax benefits can improve your overall return, even when the property is generating income. Understanding how these losses work and when they can shelter other income is crucial for effective tax planning in real estate investing. When it comes to capital gains, the holding period plays a crucial role in determining how your profit is taxed and ultimately how much money you get to keep. The key idea here is that time can actually reduce the tax burden, often referred to as lowering the tax drag. Let's start with short-term capital gains. These apply when you hold a property for 1 year or less. The gains you realize are taxed at ordinary income rates, which typically results in the highest tax burden. This approach tends to be more suitable for quick flips rather than patient, long-term investing. Because of the higher tax rates, more of your gains get eaten up by taxes, which can shrink your net return significantly. On the other hand, long-term capital gains come into play when you hold a property for more than 1 year. These gains benefit from preferential capital gains tax rates, which generally improves your after-tax profit when you sell. Long-term holding aligns better with the steady income from rentals and property appreciation, supporting a more sustainable wealth-building strategy. For most investment properties, holding beyond that 1 year mark is usually the clearer path to stronger after-tax returns. So, the core principle here is simple but powerful. By holding your investment property long-term, you can often keep more of your profits and build wealth more effectively, while short-term holding tends to come with higher taxes and lower returns. Let's talk about the 1031 exchange and how it helps with deferring capital gains taxes. First, you start by selling your original investment property. Now, you might expect to pay capital gains tax right away, but if you keep the proceeds within a qualified exchange structure, this gain is not recognized immediately. Instead, you reinvest those proceeds into a replacement property that is considered like kind, meaning it's similar in nature or use. Then, when you acquire this replacement property, the tax on your gain is deferred, not eliminated. This is a crucial point because deferring the tax allows you to preserve more of your equity, which can be used for the next investment. The core rule behind a 1031 exchange is that it enables investors to roll over profits from the sale of one investment property directly into another without triggering an immediate capital gains tax. This strategy is especially important for those looking to grow their real estate portfolio while managing their tax liability effectively. When you sell a property, any depreciation you claim during ownership is subject to depreciation recapture. This means that the IRS taxes back the amount of depreciation you've taken before applying the capital gains tax to the rest of the sale profit. Typically, this recaptured depreciation is taxed at a rate of 25%. Let's look at a simple example to clarify this. Suppose you claim $40,000 in depreciation. At a 25% recapture rate, the recapture tax would be $10,000. This happens because the depreciation reduces your adjusted basis in the property. So part of your sale proceeds will effectively be taxed again as income instead of capital gains. The key takeaway here is to plan for depreciation recapture when selling, as ignoring can mean underestimating your tax liability and overestimating your net proceeds. This is especially important for investors, as it can significantly impact the financial outcome of the sale. Understanding this helps you prepare better and avoid surprises during the transaction. Let's take a closer look at a real-life example with this single-family investment case study. The property was purchased for $385,000 with a 20% down payment and financed through a 30-year fixed loan. This setup provides stability and predictability in mortgage payments. The monthly rent is set at $2,850, reflecting a stabilized lease within a strong suburban market, which is key for consistent income. Our initial projections show a monthly cash flow of about $410, which is a positive return after expenses. Additionally, we expect the property to appreciate by around 3% annually, increasing its value over time and enhancing the overall return on investment. This example highlights how carefully balancing purchase price, financing, rent levels, and market conditions can create a profitable single-family rental investment. Here, We're looking at a case study that illustrates the tax picture for the first year of owning a rental property. Even when a rental is profitable in cash terms, it's possible for it to show a taxable loss once we factor in interest, taxes, and depreciation. Let's break down the numbers. The rental income for the year is $27,600. From that, we subtract operating expenses of $6,900, mortgage interest of $9,800, and property taxes of $3,400. These three items are deductible expenses. After these deductions, we have a taxable income of $7,500 before considering depreciation. Now, depreciation is a non-cash deduction, meaning it reduces taxable income without affecting actual cash flow. In this case, depreciation amounts to $18,275. When we apply depreciation, the taxable income moves from a positive $7,500 to a negative $10,775. This negative figure is referred to as a paper loss. The bottom line here is important. This paper loss of $10,775, when multiplied by the marginal tax rate of 24%, results in estimated tax savings of $2,586. In other words, this loss can offset other taxable income, reducing your overall tax liability, if allowed. It's critical to distinguish between cash flow before taxes, which is the actual income left after paying cash expenses and interest, and the taxable income, which includes these non-cash deductions like depreciation. Understanding this dynamic helps investors appreciate the tax benefits tied to rental properties, even when there's a reported loss on paper. Let's walk through this case study focusing on appreciation and sale over a 10-year period. Initially, the property is purchased at $300,000 in year 0. By year 5, the value has increased to $348,000, showing steady growth. Then, by year 10, the estimated value reaches $403,000. The property is sold for $400,000, which is just slightly below the estimated value. Over the 10 years, the property appreciated by about $100,000, translating to an average annual growth rate of around 3%. Now, breaking down the sale scenario, the sale price is $400,000, but we deduct selling costs of $24,000 and an adjusted basis of $190,900, leaving a taxable gain of $185,100. From this gain, capital gains tax comes to $23,115, and depreciation recapture tax is $27,275, totaling $50,390 in taxes due. After all these deductions, the net proceeds amount to about $325,610 before any loan payoff. This example highlights how appreciation, growth rate, and tax considerations affect the overall return from a property sale, especially in the context of single-family housing investments. Investment mistakes often come down to a few common pitfalls that are predictable and, importantly, preventable. One major area of focus on is managing risk before you even make a purchase, as protecting your return starts there. First, over-leveraging can be a big problem. When you take on too much debt, it amplifies the risks related to vacancies and interest rate changes. To avoid this, stress test your payment scenarios thoroughly and maintain adequate cash reserves to cover unexpected shortfalls. Second, underestimating expenses can seriously erode your cash flow. Things like repairs, tenant turnover, insurance, and vacancies all add up. The key here is to underwrite your deals with realistic assumptions for maintenance and vacancy rates, so you aren't caught off guard by higher costs. Third, ignoring tax planning can reduce your after-tax profitability. Many investors miss out on valuable deductions simply because they don't track their basis, depreciation, or deductible operating expenses carefully. Keeping good records and understanding tax implications can make a significant difference in your net returns. Finally, poor timing, buying or selling without a clear sense of market conditions, can hurt your overall returns. It's important to align your deals with current financing conditions and your anticipated holding period to maximize value. By avoiding these common mistakes, you can better protect your investment and enhance your chances of success in single-family housing. When we think about building a resilient real estate portfolio, Diversification is key. First, mixing different property styles helps spread out maintenance and tenant risks, so you're not overly exposed to any one issue. Second, balancing locations across various neighborhoods ensures that you're tapping into different demand drivers, which can stabilize your income streams. Third, combining properties that generate income with those that are likely to appreciate means your returns won't depend solely on a single market cycle. Ultimately, diversification turns what could be just one house into a thoughtful, strategic portfolio. This approach is especially important when considering single-family housing, where pricing, investment, and tax factors all play a crucial role in shaping your overall success. Let's go over the 5 key ideas that are crucial when evaluating a single-family housing investment. First, location is fundamental. It essentially sets the ceiling for the property's value, no matter how well the property is maintained. If the location isn't desirable, the potential value is limited. Next, pricing is driven swiftly by the forces of demand and supply. When demand outpaces supply, prices rise quickly and vice versa. Then we have property quality, where the condition and timing of your investment can significantly shape how buyers perceive the value. High-quality properties or well-timed purchases often attract better offers. Moving to investment analysis, returns come from 3 main sources: cash flow from rental income, appreciation in property value over time, and financing strategies that leverage debt effectively. Lastly, don't overlook the after-tax impact. Taxes can either enhance your real profit or erode it, depending on how you structure your investment and understand applicable tax considerations. Keeping these 5 concepts in mind provides a solid foundation for making informed decisions in single-family housing investments. As we wrap up, let's focus on the next steps to build a strong investment strategy. The key is to turn the framework we've discussed into concrete action by following 3 disciplined moves before purchasing your next property. First, analyze the local market thoroughly. Look into neighborhood pricing, rental rates, vacancy trends, school quality, and upcoming supply. This will ensure your assumptions are grounded in real demand factors that drive value. Second, consult a tax advisor. Understanding how mortgage interest, property taxes, depreciation, and your exit plan impact after-tax returns is crucial. This insight helps you maximize profitability and avoid surprises down the road. Third, model various cash flow scenarios. Stress test best case, base case, and worst case situations factoring in financing costs, repairs, reserves, and potential rent fluctuations. This helps you prepare for uncertainties and make informed decisions before committing your capital. Remember, the best investment decisions come from thorough planning and realistic, evidence-based analysis. Build your plan carefully before you buy.